Sensex plunges, Nifty dives. What the heck happened? Booyah! Welcome back to Dalal Street Decode, folks. Or should I say, welcome to the war zone, because that's what the markets looked like today. A sea of red. The Sensex crashed. We're talking a stomach-churning 873 points gone. Vanished. Poof. And the Nifty. It took a nosedive, plunging below that critical 24,700 mark. If you weren't paying attention, you are now. This wasn't just a dip, people. This was a full-blown sirens wailing code red sell-off. So, what lit the fuse on this powder keg? What greased the skids for this massive slide? Was it something brewing overseas? Those pesky global cues rearing their ugly heads again? Or was it just good old-fashioned profit booking? Investors cashing in their chips after a good run? Maybe a bit of both? Don't you worry your pretty little portfolios about it, because that's why I'm here. We're going to rip this market apart piece by piece and figure out exactly what went down on Dalal Street today. This is your post-market wrap, your deep dive analysis, your no-holds-barred breakdown of all the action. Right here on Dalal Street Decode, we don't just report the news, we explain it. We connect the dots. We tell you what it means for you and your money. So buckle up, buttercups, because class is in session. And Professor Kramer, your favorite DSD host, is about to drop some serious knowledge. Ski douche. All right, let's get right into the guts of this thing. First up on the chopping block, the US-India trade deal. Or should I say, the lack of a US-India trade deal. Remember all that sunshine and rainbows? All that optimism about a fantastic agreement just around the corner? Well, folks, that optimism is fading faster than a cheap suit in a rainstorm. Investors are getting antsy. They're tapping their feet. They're looking at their watches. They want clarity. They want to see some action. And can you blame them? China locked down a deal with Washington. The UK, they got their handshake. So where does that leave India? Twiddling its thumbs, apparently. The silence from the negotiation table is deafening. And in the market, silence isn't golden. It's a breeding ground for fear. Investors are now looking for some real concrete news, some sign that this deal is actually going to happen. This isn't just some minor hiccup, people. This is a major sentiment driver, or in this case, a sentiment dragon. The so-called experts, the talking heads, they're all saying the same thing. The domestic market is likely to remain range-bound, stuck, going nowhere fast, all because we're waiting for some significant clarity on this trade deal. You hear that? Range-bound. That's code for boring, for frustrating, for investors sitting on their hands, or worse, hitting the sell button out of sheer impatience. We need a catalyst, a spark, something to get this market moving in the right direction again. Now I hear whispers, reports from Bloomberg, that India is discussing a US trade deal structured in 3 tranches, 3 parts, and they expect to reach an interim agreement, a sort of down payment on the deal, before July. July? That's still weeks away. In market time, that's an eternity. Do you think Mr. Market has the patience of a saint? No, he wants results and he wants them now. This may be before July. Talk isn't cutting it, not by a long shot. Next up, let's talk about something that's been giving me heartburn for weeks. Valuations. Are stocks too expensive? Are we in a bubble? Are we flying too close to the sun on wings made of wax and hope? The numbers, my friends, the numbers don't lie, and right now they're screaming caution. The domestic market, our beloved Nifty and Sensex, they've had a heck of a run, but valuations are stretched, tighter than a drum. Let's get specific. The current Nifty PE, that's price to earnings ratio, the granddaddy of valuation metrics, is sitting at a lofty 22.3. Now what does that mean? It means it's at a 6-month high, and it's slightly above its 2-year average PE of 22.2. That might not sound like much, but in the world of valuations, every decimal point counts. It tells you that investors are paying a premium, a big premium, for future earnings. And that's a risky game. I was listening to VK Vijayakumar. He's the chief investment strategist over at GeoJet Investments. Smart guy, knows his stuff. And what did he say? He said, in the near term, the market is likely to move to a consolidation phase. Just when you thought it couldn't get any crazier, bam! Moody's, one of the big kahunas in the credit rating world, decides to drop a stink bomb on the party. They downgraded the US sovereign credit rating. Yes, you heard me right. The good old US of A, the bedrock of the global financial system, got its creditworthiness dinged. They took it down a notch, from the tippy-top AA to IA1. That's not just a little oopsie, folks, that's a big deal. And why, you ask, did Moody's do this? What's their beef? Well, it's a 1-2 punch. First, the country's growing debt. It's piling up higher and higher like a mountain of IOUs. And second, persistent political bickering. Can you believe it? Washington can't seem to agree on anything, and their squabbling is now officially hurting the nation's credit. It's dysfunctional, it's embarrassing, and it's got financial consequences. Now, you might be sitting there in Mumbai or Delhi thinking, okay, Kramer, that's America's problem. What's it got to do with me and my Indian stocks? Everything. It has everything to do with you. When the world's largest economy, the issuer of the world's reserve currency, gets a black mark on its report card, it sends shockwaves across the entire globe. It rattles confidence everywhere. It's like finding out your super reliable rich uncle suddenly has a gambling problem. This downgrade, it just pours more fuel on the fire of uncertainty that's already raging. We've got the trade deal drama, we've got the sky-high valuations, and now this, it's like the market gods are conspiring against us. It makes investors already on edge even more skittish. They start looking for safer havens, they start pulling money out of anything that looks even remotely risky. And that, unfortunately, can include emerging markets like India. Think about the chain reaction. US credit downgrade leads to worries about US financial stability. That leads to a flight to safety. Chapter 4. India awaits a spark. Any spark. Alright, let's bring it back home. What's happening right here in India? What are the local triggers, the domestic catalysts that are supposed to be firing up our markets? Well, lately the answer is, not a whole lot. We've been stuck in a range, folks, like a car spinning its wheels in the mud, going nowhere. The Indian stock market has been drifting, listless for the last few sessions, crying out for some fresh impetus. The peak anxiety about tariffs, those global geopolitical tensions that had us all biting our nails, they've kind of faded into the background. It's not that they're gone, but they're not the headline grabbers they once were. So, with that old news simmering on the back burner, the market is desperately looking for something new, something positive to latch onto. We need some fresh meat for the bulls. What are we waiting for? Well, all eyes are on the upcoming Q4 GDP prints. Show us the growth. Is the Indian economy firing on all cylinders, or is it sputtering? That number is huge. And then there are corporate earnings. Are our companies making money? Are they beating expectations? Are they showing us that they can deliver the profits to justify these valuations we talked about earlier? These are the questions that need answers. Chapter 5. FPIs hit the eject button. Now let's talk about the big money, the smart money, the guys who can move markets with the click of a mouse, foreign portfolio investors, or FPIs as we call them in the biz. And what are these FPIs doing, my friends? They're getting cautious, they're getting nervous. And when FPIs get nervous, they don't just chew their fingernails, they sell, they hit the eject button, they head for the exits. And I'm not talking about pocket change here. On May 19th alone, these FPIs yanked a whopping 525.95 crore out of Indian equities in the cash segment. Let that sink in. Over 500 crore, gone in a single day. That's not a trickle, folks, that's a gush. That's a clear signal that some of the big international players are getting cold feet about India, at least in the short term. This is serious business. So, why the sudden exodus? Why are they running for the hills? It's not just one thing. It's a whole cocktail of concerns that we've been dissecting today. Those stretched valuations we hammered on earlier? Check. FPIs hate overpaying. The mixed bag of corporate earnings coming out? Check. They want to see consistent, strong profit growth. And that never-ending saga of the delayed US-India trade deal? Double check. Uncertainty is their kryptonite. You gotta understand, FPIs have a global buffet of investment options. They can put their money anywhere in the world. They're not married to India. If they see better risk-reward opportunities elsewhere, or if they think the risks here are getting too high for the potential returns, they will pack their bags and leave. It's not personal, it's just business. Ultra navigating the storm and decoding your wealth. Woo! What a whirlwind, folks. A brutal day on Dalal Street, no doubt about it. The Sensex got clobbered, the Nifty took a beating. We've peeled back the layers, we've looked under the hood, and we've seen what caused this carnage. The US-India trade deal limbo, valuation stretched to the breaking point, Moody's raining on America's parade, a drought of fresh domestic triggers, and those FPIs voting with their feet and their wallets. It was a perfect storm of negativity. But here's the deal. Panic is not a strategy. Running around like a headless chicken won't help your portfolio. This is where the real work begins. This is where being informed, being prepared, and having a game plan matters. That's why you tune into Dalal Street Decode. We're not here to sugarcoat things. We're here to give you the unvarnished truth, the hardcore analysis, so you can make smarter decisions with your hard-earned money. Knowledge is power, especially in these choppy waters. So that's our deep dive for today. If you found this breakdown valuable, if it helped you make sense of the madness, then do your old pal a favor, smash that like button, share this video with anyone and everyone who needs to hear it. And most importantly, if you haven't already, hit that subscribe button for Dalal Street Decode and ring that notification bell. We're here every day, decoding the markets so you can decode your wealth. Until next time, stay sharp, stay informed, and booyah!
Follow at Dalal Street Decode for tomorrow's episode.